Hello, everyone. I'm Mike at Marlin Financial Advisors. Today, I'm going to share with you the simplest guide I have to investing and saving money in your 20s. This would be if someone came to me as a client and they're in their 20s or they're starting investing, maybe in their 30s, somewhere in there, and they said, hey, I just want the quickest explanation on what I should do and how to do it and a couple different things like that. This is what I'd share with them. I'm going to try to keep it as short as possible. So here we go. So every paycheck you get, right? You get money, and you have three ways to put this money towards good use. I recommend 15% of every paycheck should be put to good use. And you want to make sure it's automatic and you do it frequently. So it's not like, oh, you save up for 6 months and then you put money somewhere. No, you do it every paycheck or every month, and you have a plan, and you put it towards where it needs to go to build your financial future here. And these are the three options, right? You can save the money in cash for probably most likely an emergency fund. You can pay off debt, or you can invest, and in theory, probably most likely investing for retirement. If you're saving for an emergency fund, right, 3 to 6 months, we've all heard that. High yield savings account, most likely for everyone. So it makes a little bit of money, but not really much. It's really more for liquidity and safety. Paying off debt. People don't realize that if you if you put $10,000 towards paying off your car loan and it's at 7% interest, well, it's the same thing as investing and making 7%. Okay. So especially right now when rates are super high and you're paying a ton of money, sometimes it's mathematically the best thing to do is actually pay off debt early, right? If you have 7% or higher debt, I would consider just getting rid of it. It'll save you in the long term, right? Investing for retirement is the next option people most probably think about. Always get the match here, but then once you're done with that, make sure you've taken care of your emergency fund and paying off any high interest debt before you actually start saving for retirement, because these two will actually help you out a lot more than you think early on in life. And then once you have safety and you have your emergency fund and you have very little debt, then you can start becoming more aggressive in your retirement accounts and saving for retirement. And if you're someone that doesn't understand the market or doesn't like to invest because you don't understand the risk, or I don't ever want to lose money, blah blah blah, then you want to stay over here on the left side of the screen and you want to build up more cash reserve and pay off more debt and de-risk your life first, and then you can take more risk with investing. Okay, let's get into some more stuff here. And we're going to go over to Portfolio Visualizer, where you can see how different asset classes or funds have done. So I'm going to show you the couple funds or investments I recommend, and I only recommend stock funds that buy you a diversified portfolio of stocks. So think S&P 500. It's going to buy the largest 500 companies in the U.S. and you basically get returns of however those 500 companies do, right? The nice thing about buying through ETFs or mutual funds is they do all the work for you. They buy all the 500 companies or whatever index they're tracking. So it's super simple. You just have to buy one fund or ETF, and it gives you 500 companies of diversification. It gives you basically the whole U.S. economy, and that's the two items I would have people invest in, is either a U.S. large cap fund or ETF, or a U.S. total stock market fund, which are these two right here. And I'm going to show you how they've done since 1993. And if you can tell, they've done quite well, right? You put 10 grand in 1993, it'd be worth 182,000 right now. So think of that, right? When you're thinking, okay, I'm 30 or 25, I have 30 years. Well, if I could have just come up with 10 grand, I'd have this much, right? Obviously, this is not inflation adjusted. Let's get inflation adjusted numbers here. So if you put in 10 grand in today's dollars, you would have about 8 times that by the time you retire, right? So great returns, but there's obviously up and downs. But when you're young, right? Think you have 30 years till retirement. You have so many years. Volatility in the middle here doesn't matter. You just want this. You want this. You want to look at this number. Compounded annual growth rate, right? On average, it made you 9.82% or 9.92% a year. You don't care about the up and downs that much. You just want this thing to be high, and it is when you invest in the total US stock market or the 500 largest companies, which is the S&P 500. What I wanted to show you here is if you do a total market index or the S&P 500, they perform very similarly. So you don't have to worry about, oh, which one's best. They do pretty much the same. It's tracking the whole US economy or large corporate economy, which has done amazingly well and most likely will in the future, right? So there we go. And I want to show you how these compare. So this would be the S&P 500 index up here. Let's compare this to cash. And I want to show you bond market. And so you can see why there's a big difference here. Okay, so if you put money in here, inflation adjusted, into cash, you would have less money. So if you're saving for retirement, you can't put money in cash or a high yield savings account, whatever it is. You would lose a little bit of your money. Say you'd break even, keeps up with inflation. Okay, bonds make you a little bit of money. You would have $17,000 instead of $84,000. Do you see that right there? So when you think, okay, I have 30 years to invest, what would I rather have at the end of 30 years? 85,000 or 17? That's the problem, is bonds are great for stability, but they don't give you the greatest return long term. Let's take a look up here. We have it's made you about 4.33% or about 2% over inflation. Cash has made you less than inflation, and the market's made you about 7% over inflation. So that's the key. Do you want 2% over inflation? You want 7? Okay. When we're talking long term, we need to stay in equities, and we need to stay in U.S. stock market, different things like that. If we're talking short term goals, then maybe cash and bonds come into play. But retirement, you got to stay equities at least until you're, maybe 5 or 10 years away from retirement, and then you can think about it. For right now, just S&P 500 total market index. Okay, so here are the some examples of funds you can be in, right? So this is a couple examples. I don't recommend SPY because it's expensive, but here, these three right here, IVV, VOO, SPLG, and here's their actual names on the left. And those all three do the same exact job. It's just with different companies. It doesn't matter. It's just tracking the S&P 500. Okay. And then let's take a look at total market indexes if you wanted maybe a little bit more exposure to some other pieces of the market. VTI is an option, SEHB, and there's one more, ITOT, right? All super cheap expense ratios, which is good, so it doesn't cost you a lot. And if you notice, they have all the same performance. So it doesn't matter which fund you pick here. 10.8, 10.9, 10.8, right? They're all extremely close and similar. Okay. So we've gotten that done. Let me see, what else do I have? What else did I want to share? So here, this is me showing you 3 different funds for the S&P 500, and they do exactly the same. Look, you can barely tell that there's a difference, the difference between yellow and red, right? So all of them are within about 3. I'm sorry, I didn't want to use about 3. Hold on, let me analyze this. They're all within. One's actually the lowest, $300 off, which is interesting. The SPLG, but IVV and VOO are the exact. I mean, they're exact same dollar amounts, and that's over 10 years, 12 years here. So it doesn't matter which one. Pick your favorite by the name or the symbol. It doesn't matter much. We just want a low expense ratio, and we want to make sure it's either tracking S&P 500, total market, U.S. stock index, or something similar. But there you go. That's what I would do. And we don't need that. Okay. And just remember, if you want lower risk, you go savings. and you go paying off debt. Okay. If that makes you more comfortable. But once you've done that and de-risk your life, then you can move over here and start investing in your retirement account. Always get that match anytime you can, because it's really going to pay off. It's free money. And make sure you're just consistently doing it, and you're putting you got to take 15% of your paycheck and you got to use it for good things. You can't buy Starbucks, and you can't have an expensive lease in your car or anything like that. You gotta help yourself first, and that needs to be probably 15% a month. Once you do that, you're in great shape. Nothing more. If you have questions, leave them below. Take care.